Welcome to the deep dive. We're here to cut through the noise, get straight to the insights you need. Now, if you've been watching the market lately, you know that feeling, right? That almost irresistible pull. Valuations look, well, alarmingly high.
They really do.
Yet the market keeps climbing, mostly led by those same familiar tech growth stocks.
Yeah, the usual suspects.
It's that classic fear of missing out FOMO. You feel it pushing investors right into what seems like maybe an aging rally's biggest winners.
Definitely. We've all felt that pressure, that little voice saying, just jump in, everyone else is.
Exactly.
But, it's precisely there that the truly savvy investor often pauses, takes a different path.
Okay.
So while many are getting swept up in that, let's call it the tech hype cycle,
Right.
some investors are looking at this moment and thinking, maybe too much risk here. Not enough reward in those really popular sectors.
Interesting.
What's compelling is that the smart money seems to be actively seeking out blue chip prospects. Specifically, outside of that intense AI, artificial intelligence-driven mania.
Okay, so outside the AI hype, where are these savvy investors looking then? Where's the value?
Good question.
Because that's our mission today, right?
Yeah.
To unpack why they're eyeing opportunities that maybe they've underperformed recently.
Yeah, things that haven't kept pace.
But could offer significant long-term upside, maybe starting to show up in the latter half of this year.
Potentially, yes.
So we're going to dive into 3 specific Dow Jones Industrial Average stocks. Key point: they are not caught up in this current bullish frenzy.
Right, not the ones everyone's talking about constantly.
The goal is simple. Give you a shortcut to understanding this, let's say, contrarian view.
Yep.
And why it might just be a smart move for your own portfolio.
Okay.
So our first deep dive might surprise some people, especially given recent headlines. Let's talk about Apple.
Apple. Okay.
Yes, that Apple. And you might be thinking, Apple, not caught in the AI mania.
Well, yeah, they've certainly been trying to be in it.
Right, and you'd be somewhat correct there. The reports are the iPhone maker kind of, botched its big consumer-facing AI splash.
That's the narrative, certainly.
That Apple Intelligence platform they launched, or tried to launch, back in October, it came out without several features people were expecting.
And the rollout itself was limited.
Exactly. And the really surprising detail, it's only available if you own the very newest iPhones.
Which cuts out a huge chunk of their user base, initially at least.
Plus, the updated series, reports say it's been a bit of a flop.
Yeah, not the revolution people hoped for.
Led to a management shakeup, apparently a back-to-the-drawing-board decision, that big Siri leap, pushed to early next year now.
So a definite delay.
And this whole saga really is a chief reason Apple shares have struggled since late last year.
Okay, so you've laid out the challenges, the botched launch, the delays. It paints a picture. And many might argue this isn't just a temporary stumble. Maybe it's a fundamental failure, something that could impact their whole ecosystem for years.
That's a valid concern, absolutely.
But here's the core insight, maybe the contrarian view. The market often overreacts. Short-term missteps get amplified.
Okay.
Apple's botched AI launch isn't just a failure. It could be the very reason for its current, let's say, undervaluation.
Setting the stage.
Exactly. Setting the stage for a strong rebound once those delayed features actually arrive. It's a classic case. Buy when others are, maybe overly pessimistic or just selling.
Right. Buy the dip, essentially, but based on future potential.
Precisely. As FuzzStrat's Tom Lee put it, and he's quite respected despite the current challenges, he said, for me, Apple has been sort of quietly ready to pounce on AI.
Interesting phrasing. Quietly ready.
So, I think Apple's going to surprise people. This extra time, this delay, it also allows for a new wave of iPhones, ones actually capable of handling the onboard AI that Apple Intelligence needs.
Right. And the hardware needs to catch up, too.
And it seems the market, the crowd, is slowly starting to come around to Lee's way of thinking. You see the stock's recovery from that low back in April. It's picking up some steam.
Yeah, it has ticked up a bit.
There's still plenty of room for those shares to keep marching higher, even before they get back to their peak from last December.
Okay, so Apple, short-term pain maybe, but a potential long-term gain if they execute on that AI promise later.
That's the thesis, yeah.
All right, from a tech giant trying to pivot, let's shift gears. Let's talk about a retail behemoth, Walmart.
Okay, Walmart. Solid, dependable.
Well, dependable, yes, but it's also quietly reshaping its identity and its revenue streams.
Interesting. Tell me more.
Walmart shares actually had a fantastic 2024. I mean, a rock star performance. They rallied over 70% in 12 months.
Wow, 70%. That's huge for a company that size.
Exactly. Driven by progress most investors just didn't seem to expect. But since then, not much follow-up.
Sculled out a bit.
Yeah, the stock is barely above where it ended last year. It's largely moved sideways since May. It feels like the market is just waiting for the next big catalyst, the next headline.
That waiting game, though, it might actually be a mistake.
How so?
Well, a compelling part of investment strategy sometimes is realizing the time to step into a stock isn't always when everyone else is piling in during a news-driven rally.
Right, not chasing the momentum.
Exactly. It's often in the quiet period, the calm before the potential storm, acting on faith, maybe, that the bullish news is coming.
So you're saying there is reason to believe Walmart will provide those catalysts?
Well, look at the evidence. It's not like there's reason to believe they won't deliver. Take their fiscal first quarter results.
Okay.
Despite a, pretty lethargic economy, Walmart still managed respectable top-line growth, 2.5% or 4.4% if you adjust for currency.
Not bad in this environment.
And U.S. same-store sales, up 4.5% year over year. Operating income grew 3%. Now, these aren't like flashy tech numbers.
No, certainly not.
But for the world's biggest retailer, kind of limited by its sheer size, dealing with tariff issues, that's solid growth, really solid.
Okay, solid retail performance.
Yeah.
But you mentioned reshaping identity. What's the deeper insight here for Walmart beyond just selling stuff in stores?
Yes. The true deep dive insight isn't just its retail resilience, it's the stealth transformation.
Stealth transformation.
Into an advertising and e-commerce powerhouse. Most investors, you talk to them, they still just see bricks and mortar Walmart.
Okay.
They're completely missing this multi-billion-dollar advertising revenue stream that's growing at double digits.
Advertising at Walmart.
Think about Walmart.com's ad business. It grew 27% last year, hit $4.4 billion, then soared by double digits again in Q1.
Wow, okay, that's significant money.
And their e-commerce arm grew 22% worldwide in the first quarter, boosted by deliveries by their growing number of Walmart Plus subscribers.
So online is really humming.
The point is, in an environment that's supposed to be tough for retail, Walmart is making it look, well, pretty easy.
Huh. That's the hidden engine then.
That's a hidden engine driving future value. The market is only just starting to maybe grasp it, and it should start rewarding that again soon enough.
Okay, Walmart. More than just a store, becoming a digital platform powerhouse. Interesting.
Exactly. Now, our journey through these contrarian plays wouldn't be complete without touching on healthcare.
Right.
Let's turn our attention to Johnson & Johnson, J&J. Another one kind of flying under the radar, but with a potentially, well, let's say explosive future.
Johnson & Johnson. Okay, a household name. They were huge during the pandemic, weren't they?
They certainly were. J&J was one of the market's hottest stocks during and largely because of the COVID-19 pandemic.
The vaccine.
Their J-Covden vaccine. It was a rapid mass production success story, really. Generated over $2 billion in revenue in 2021, nearly repeated that in 2022.
Big numbers.
But, the need for that specific vaccine effectively ended in 2023.
Right, the urgency faded.
And stepping back, looking at the bigger picture, the scale of that whole pandemic-driven rally, maybe it never quite made sense for J&J overall.
How do you mean?
J-Covden, the vaccine, was never really a major breadwinner in the grand scheme of J&J's massive, sprawling business. It was significant, but not dominant.
Okay.
And to offset that waning vaccine revenue, plus you had slight but persistent sales declines from older drugs like Remicade, Simponi, and Brivica, J&J just didn't have a huge immediate offset ready to go.
So a gap was created.
Exactly. That's largely why Johnson & Johnson shares have seen more misses than hits since, say, 2022.
Okay, that explains the underperformance. But you said explosive future. What's changing? Why is this pharma stock maybe starting to make higher highs and higher lows again?
Because there's tangible hope on the horizon now. Real significant hope.
Okay.
The key insight emerges when you see J&J's going all in, really all in on oncology, cancer treatments.
Oncology, that's a huge field.
Huge. And they've not only invested a ton of money developing their own cancer drugs, but they've also spent billions acquiring promising cancer-fighting prospects from other companies.
Buying innovation, too.
Exactly. A great example is Ambrx Biopharma's ARX-517. It's what's called an antibody drug conjugate, or ADC, aimed at prostate cancer.
ADC, seeing that acronym more often.
You will. J&J is looking to build a really deep and wide portfolio of these ADC cancer drugs. Their Senior Director of Oncology Innovation, Stefan Hart, stated it plainly late last year.
What did he say?
Basically, that J&J's growing pipeline of ADC therapeutics, plus their external deals, reflect their huge investment and confidence in the future of this ADC space. They're betting big.
So they're building a major new pillar for the company.
A potentially massive one. And what's remarkable is investors might not have to wait that much longer to see the results, the fruits of this labor and investment.
Really? What's the timeline look like?
The company itself contends its oncology business will be worth $50 billion per year by 2030.
$50 billion just from oncology.
It's just oncology. Now, put that in perspective. Their total cancer-related revenue last year was just over $20 billion.
Okay.
And their total company top line was just under $90 billion. So $50 billion from oncology alone. That's a significant projected increase in one key area.
Wow, that would fundamentally change the company's profile.
Absolutely. So what does this mean for investors? Well, if this strategic shift plays out, if they execute, J&J stock will naturally reward the progress made towards that ambitious goal along the way.
So you get rewarded incrementally as they hit milestones.
Exactly. The quiet groundwork is absolutely being laid right now for something potentially very big.
Okay, so J&J leveraging its scale to build a future powerhouse in oncology, moving beyond the pandemic narrative.
That's the core idea, yes.
So wrapping this up, what does all this mean for you, the listener? This deep dive really explored that crucial shift, didn't it? Moving perhaps from those riskier, sometimes volatile tech growth stocks, often driven by that FOMO we talked about, towards more predictable, maybe blue chips.
Yeah, a different kind of opportunity.
And we saw how each of the three companies we discussed, Apple, Walmart, Johnson & Johnson, presents its own unique case for long-term upside, despite, or maybe even because of, their current position outside that main AI hype.
Right. And zooming out, the relevance here, the broader strategy, is understanding that when you step into a stock, isn't always about joining that loud, news-driven rally.
Yeah, it's not always about chasing headlines.
Sometimes it's about having that, well, maybe faith is too strong a word, but confidence. That the bullish news is coming. Stepping in during the calm before the potential storm.
Looking ahead.
It's about looking at the fundamental strength, the future potential, rather than just chasing the stocks that went up the most last week or last month.
So as you think about market trends, maybe your own investment approach, here's a provocative thought to leave you with. If the smart money, as we've discussed, is already looking beyond the obvious, beyond the current darlings, what other established companies, or maybe less hyped sectors, might be quietly building significant value? Value that just isn't reflected yet in the market's current spotlight.
That's the key question, isn't it? Where's the next opportunity hiding?
Maybe the next big thing isn't actually new. Maybe it's something tried and true, just evolving powerfully behind the scenes.
Could be. It really makes you rethink what innovation means in some of these established giants.
Definitely something to think about.